The March 2023 banking crisis centered around Silicon Valley Bank, Signature Bank, First Republic and Credit Suisse was essentially a modern replay of asset-liability mismatches, but with a different balance sheet structure compared to 2007-2008. How did asset-liability mismatches materialize? At the core of the crisis were regional and mid-sized US banks, the ones we already mentioned, most prominently Silicon Valley Bank. Assets were long-term, illiquid and sensitive to interest rates. These banks held large portfolios of long-dated treasury bonds and mortgage-backed securities, MBS. On the contrary to 2007-2008, these were very safe in credit terms, meaning low default risk, but they are extremely interest rate sensitive. When the Federal Reserve hiked rates aggressively from 2022 onward to tame inflation, the market values of these fixed income securities dropped sharply. The so-called duration risk, which reflects the interest rate sensitivity of fixed income securities. If you're more interested in the mechanics of bond prices and yields that move inversely, or to gain a deeper understanding of this foundational concept in fixed income, please check the subsequent article. On the liability side, we found short-term concentrated deposits. Especially SVB relied heavily on the funding side on short-term deposits, particularly uninsured deposits from corporates and venture capital-backed startups. These depositors were highly concentrated, not sticky, and very quick to move once fears set in. Digital withdrawals accelerated this dynamic. Unlike in the GFC, when funding markets froze outright, in the 2023 crisis, deposit flight had a clear destination. The short-term, flight-prone liabilities largely fled into three safer havens. Namely, larger systemically important banks. Depositors moved money from regional and mid-sized banks to too big to fail institutions like JP Morgan Chase, Bank of America, Citigroup, Wells Fargo, and so on. The reason behind? Confidence that the government would never allow a GSIB, so-called global systemically important banks, to fail. Based on evidence, big US banks reported tens of billions in deposit inflows within days of SVB's collapse. Another destination for the flight of safety were money market funds. A huge chunk of deposits went into MMFs, which invest in US treasuries as well as reverse repo with the Fed, so via the Fed's overnight reverse repo facility. MMFs were attractive because they offered higher yields than bank deposits, which lagged the Fed rate hikes. There was also inflow directly into short-term government instruments since the interest rates on the shorter end were quite high. Some depositors, especially corporates and institutional investors, bypassed banks altogether and bought treasury bills and other highly liquid government securities. These were considered safer, liquid, and also yielded more than bank deposits. So how did the mismatch materialize? Long-term illiquid interest rate sensitive assets, implying the duration risk, versus the short-term flight-prone liabilities, which reflected the liquidity risk, in particular the rollover or short-term funding risk. How did the liquidity crisis play out? When concerns about Silicon Valley Bank first emerged in March 2023, depositors began to withdraw their money at an extraordinary pace. To meet these outflows, SVB was forced to sell part of its bond portfolio, which immediately locked in billions of dollars of unrealized losses. The disclosure of these losses shook confidence even further, sparking a classic bank run. Very quickly, panic spread to other institutions with similar business models and balance sheet structures, most notably Signature Bank and First Republic, which also faced destabilizing waves of deposit withdrawals. How was liquidity ensured across the system? Policymakers stepped in quickly to prevent contagion. So guaranteeing deposits was the first step. The FDIC, Federal Reserve, and US Treasury jointly guaranteed that all deposits at SVB and Signature, even those above the standard of $250,000 FDIC insurance cap would be protected. This was key to stopping panic withdrawals at other regional banks. Furthermore, the new Fed lending facility. The Federal Reserve launched a Bank Term Funding Program, PTFP. This allowed banks to borrow against their securities like treasuries and agency debt as well as MBS at par value, not at depressed market value. This meant banks didn't have to sell securities at a loss just to meet withdrawals. In effect, it neutralized the mark-to-market problem on their safe asset holdings. As well as a discount window and liquidity lines were established. The Fed also encouraged broader use of the discount window, providing liquidity against a wide range of collateral. And last but not least, market backstopping. By stabilizing depositors' confidence and providing funding facilities, the authorities prevented fire sales and stopped contagion from spreading to the wider system. The collapse of Credit Suisse in March 2023 happened at almost the same time as the US regional bank runs. But the mechanics were somewhat different. Unlike SVB, Credit Suisse was not undone by holding long-dated bonds with huge unrealized losses. Instead, its problems stemmed from chronic profitability and risk management issues. Credit Suisse had been weakened for years by scandals, losses, and compliance failures. This eroded its profitability and investor trust. However, and most notably, there was a reliance on short-term market funding. As a global investment bank, Credit Suisse depended heavily on wholesale and market-based funding like repos, derivative exposures, and prime brokerage balances, which is highly sensitive to confidence. On the asset side of the balance sheet, large derivatives and off-balance sheet exposures could be found. It carried complex trading book positions that were harder for outsiders to value, fueling fears about hidden losses. What about the trigger in March 2023? As the US regional banking crisis unfolded, global markets began scanning for vulnerabilities beyond the United States. Credit Suisse, already weakened by years of scandals, losses, and governance failures, quickly came into focus. The final spark came when its largest shareholder, the Saudi National Bank, publicly ruled out providing any additional capital. That statement sent shockwaves through the market and unleashed a fully blown confidence crisis. Clients and counterparties rushed to withdraw funds, with outflows reportedly exceeding 100 billion Swiss franc between late 2022 and early 2023. Unlike US regional banks, which collapsed due to large unrealized losses on their bond portfolios, Credit Suisse's problem was not primarily interest rate risk. Instead, it was the sudden acceleration of a long, shimmering trust deficit. What about the liquidity support and resolution in this case? The Swiss National Bank provided massive liquidity support, so over 100 billion Swiss franc. Despite this, market confidence could not be restored. Investors feared insolvency rather than just illiquidity. Within days, Swiss authorities engineered a forced takeover by UBS, its past competitor, to prevent disorderly failure and systemic contagion. The resolution included controversial measures such as wiping out 16 billion Swiss franc of additional Tier 1 bonds, even as equity holders received some value, which unsettled investors in European bank debt markets. Let's conclude this lecture by drawing attention to the contrast between the asset-liability mismatches in the GFC and this spring 2023 banking turmoil. When it comes to the nature of assets, during the GFC, assets were complex, opaque, and risky. Mortgage-backed securities, collateralized debt obligations, and structured investment vehicles were at the center stage. Credit risk was fundamental. Rising defaults in subprime mortgages impaired asset values. In the 2023 crisis, assets were safe in credit terms but risky in duration, meaning that long-dated treasuries, agency, MBS, and traditional loans, so meaning commercial mortgages and tech startup lending, did not carry default risk. To reiterate once more, no credit deterioration but massive interest rate risk due to Fed's fastest hiking cycle in decades. What about the nature of liabilities? In the GFC, there was a reliance on short-term wholesale funding, meaning repo markets, asset-backed commercial papers, as well as interbank loans. On top of this, shadow banking institutions like money market funds, structured investment vehicles, and investment banks depended on rolling over short-term liabilities. In the 2023 crisis, there was reliance on uninsured concentrated deposits. SVB, Signature and First Republic had very high shares of deposits above FDIC limits. Depositors were flighty, rate sensitive and fast moving. Venture capitals, startups, as well as wealthy households. At Credit Suisse, reliance on confidence sensitive wealth management deposits and wholesale funding made it fragile to trust shocks. And what about the trigger of the crisis? In the GFC, credit losses triggered the crisis and asset write-downs followed. These led to doubts about solvency of banks and shadow banks. Fire sales of complex securitized products led to price spirals and mark-to-market losses across the system. In 2023, triggered by interest rate hikes and unrealized losses of safe bonds that exposed duration mismatches. Depositors fled when they realized banks would have to realize losses if forced to sell. For Credit Suisse, long erosion of trust due to scandals crystallized by market contagion. When it comes to the speed and transmission in the GFC, it was gradual, starting in 2006-2007. Defaults materialized. This led to funding pressures, reinforcing the panic and eventually ending up in a global freeze. Liquidity dried up in repo and asset-backed commercial paper markets first, then spread to banks. In the 2023 crisis, it was instantaneous due to the digital runs. 42 billion withdrawn from SVB in a single day. Social media and digital banking accelerated contagion. A confidence shock spread regionally and globally almost overnight. And when it comes to the policy responses, in the GFC, central banks created liquidity facilities. Governments guaranteed bank debt and recapitalized institutions, most famously the TARP, the Troubled Asset Relief Program, and system-wide solvency support was necessary. In the 2023 crisis, the FDIC, the Fed, and the Treasury guaranteed deposits even when uninsured. The Fed created the Bank Term Funding Program, as we heard, allowing bonds to be pledged at par value, neutralizing unrealized losses. And the Swiss government, as well the Swiss National Bank, arranged UBS to take over credits with liquidity backstops. It was more about liquidity confidence than solvency, except Credit Suisse, which had in general structural issues. To sum up, the GFC was a credit solvency crisis born in shadow banking, while the 2023 turmoil was primarily a liquidity confidence crisis in regulated banks amplified by digital age depositor behavior. What were the key lessons? The key lesson from 2023 is that even in well-regulated post-GFC banking systems, liquidity mismatches and concentrated uninsured funding bases can still trigger sudden runs, especially in the digital era where withdrawals are instantaneous.